Are markets too complacent? Hi, I'm Harry Melandri of MI2 and Arque Advisors. It's Fed Day, and today I'm talking macro with David Rosenberg, founder and president of Rosenberg Research. Hi, David. I'm very sorry I'm not Maggie Lake, but I will do my best to make this fun. How are you?
Good, thanks. And I think I could hear Maggie saying, "Thank God that she's not you." So you're
That's right. That's right. She couldn't pull off this hairstyle, I'm telling you.
you're one for one.
Yeah.
But you look great. You look great.
Yeah, as you were saying, I will say the same thing. I'm 59, but I got the body of a 65-year-old. It's going about as well as possible. So let's cut the small talk. I'm dreadful at it anyway. Back in May, you were a restrained bull on bonds. I think that bet worked out pretty well for you, but can we spend a little time talking about what you got right since the last time you were talking to Maggie and what you got wrong before we move on to what you're expecting to come next?
Well, I think that what I got right, which is always a pleasure to talk about, was that we were going to be seeing a substantial loosening in the labor market, and we have seen cracks. That even with the view that inflation was being sticky, which I might debate when you look beneath the surface. However, my view that tariffs were not going to induce a big run-up in inflation, that helped out as well, because just as G. Powell said at the post-meeting presser, you strip out tariffs and you look at actually market-determined inflation that's running at 2.3, 2.4, you're almost at target. So I felt good about that, felt good about the labor market. The stock market is absolutely ripped in my face. That much is true. But, I've been long the Asian stock market. So that's held me in good stead. But, I think the bond market has been a pretty good call. Bond yields have come down, hasn't been a straight line. And I thought that even though everybody believed at the beginning of the year that the Fed was done cutting rates for the cycle, I thought that they were going to be on hold for a period of time and then start the rate cutting cycle again, which they have. So that was part and parcel in the spring of me saying, I am, you can call it a restrained bull, but I did think that the Treasury curve would be shifting lower, and that's exactly what's happened, except for today.
And what are you thinking going forward?
Well, I have a less bullish view of the economy than the consensus. I understand what the stock market is doing. The stock market is pricing in an earnings boom for like the next 5 to 10 years. The duration of the stock market has really lengthened out. It's not really making a call on the cycle. And in fact, the S&P 500 is dominated by growth stocks today. It's not really that cyclical. It's become really a long duration growth index. And it's telling you about a lot of optimism on the future, but I'm not so sure it's telling you anything about the contours of the near-term business cycle. I'm looking at the economic data. Of course, we don't have the government data because of the shutdown. But we have other pieces of information. We have the incoming survey data, for example, from the University of Michigan Consumer Sentiment Index, which is in the bottom 1% reading of all time. We've got the Conference Board surveys. We have also the regional Fed surveys have come out for October, whether it's the Dallas Fed or the Philly Fed. On the services and manufacturing side, at my firm, we run a diffusion index and model it against GDP from all these incoming, call it second-year soft survey data, but that's really all we have in our hands right now. Mm-hmm. And it's actually surprisingly consistent with 0% growth in real GDP in the third quarter and in the fourth quarter, which is dramatically at odds with the 3.9% that you see in the Atlanta Fed nowcast. Now, what's interesting is that everybody this is just navel gazing. The Atlanta Fed nowcast gets all the press, but there's another Fed, the St. Louis Fed, the monetarist Fed, that has its own nowcast, and its growth is close to zero, and we're closer aligned with St. Louis than with Atlanta. But the difference between, call it 4 and 0. I mean, you could drive a Mack truck through that range.
Sure.
So I have a more downbeat or dour view of the economic outlook. Therefore, I think that, notwithstanding what you could argue was a less dovish or more hawkish tone from Jay Powell and from the Fed, I do think that the trend in market interest rates and the treasury yields will be lower over the next 3, 6, 9, 12 months. So I am sticking with that view. What the stock market does, I mean, who knows? I mean, I'm viewed as this radical perma bear, but there have been parts of the stock market that I've been long of. Healthcare and utilities in the United States, pipelines in Canada, global aerospace defense, and we've been long the Asian trade, which has actually done even better than the S&P 500. But
Sure.
I do want to have, people get the wrong idea. I do want to have toes in the risk pool, but I want to have valuation support at the same time. What unnerves me in the United States is got nothing to do with the cycle. And I'll tell you, I'm very impressed at how well earnings have held up. But, the price action has about doubled the earnings action. And people say, well, the E will grow into the P. But, I mean, you have a situation where there's a lot of earnings growth embedded in the S&P 500 that I'm not sure is going to come to fruition. But that aside, I think that the economy in the United States is in rougher shape. Housing can't get off the floor. Commercial real estate can't get off the floor. You've got a CapEx boom, and call it an 8% of GDP, called anything that is connected with AI or AI directly. But, capital spending outside of AI isn't going anywhere. In fact, all the growth in the economy this year has come directly and indirectly from AI. It's rather remarkable. But also I'm looking at, the employment statistics. And I was actually rather amazed that Jay Powell, of course, he talked more about jobless claims than anything else, although we're not getting that data. But we are getting, when I talked about we're getting private sector data, we're getting the ADP. And ADP has been negative. ADP employment has been negative 3 out of the past 4 months, and each of the past 2 months. So he talks about a, quote, gradual cooling in the labor market, to which I say, what are you talking about? The labor market's actually contracting. And it's not a case of it being just supply related, because you can see evidence that the demand for labor is actually falling faster than the supply of labor. And that's why wage trends are cooling off. That, again, underpins my more constructive view of the treasury market. So, we have housing market very weak. We have the labor market weakening. What are the two markets from a macro standpoint do you need to know? Capital spending in AI is not bigger than the housing market and labor market put together. And the other point that I would just make is this. And, people have to go check this data because they don't believe it when I tell it to them, that if you're looking at the income side of the U.S. economy and you're looking at real personal disposable income, which drives 70% of the economy, called real consumer spending, real disposable income since April is negative 1.2% at an annual rate, negative 1.2. We are actually in a personal income recession because of what the labor market is doing. But yet over that time period, consumer spending in volume terms is up 2.6% at an annual rate. Wrap that around your head. Negative 1.2 for real personal disposable income, plus 2.6 for real spending. And the fallout from that is the fact that the savings rate is falling like a hot knife through butter. And why that's happening is because of the equity wealth effect on spending.
Right.
which Jay Powell downplayed, but it's real. So you see, there's all these direct and indirect impacts of the AI trade. And in this case, it's the equity wealth effect on spending. You shudder to think what happens if the tap ever gets turned off on this AI boom.
Well, it's a race, isn't
I'll
it?
tell you, Harry, I'll tell you right now, there is no other vitality in the economy than what's happening in AI right now.
So I agree. I see exactly the same thing. But the AI build out, and it is more of a build out. I mean, it's a flawed build out because we haven't built out electricity production to the same extent we're building out data centers, which is unfortunate for those of us who pay for electricity.
Mm-hmm.
Still, the net of everything going on is GDP growth at about 2.5%. You might have forecasted, a lot of forecasters were looking for about 2. That was a middle of the road forecast. So it's actually slightly better than expected at the moment. I'm 100% with you. K-shaped nonsense or whatever. You can easily worry about what happens if the AI build out switches off before any CapEx from any other sector comes back. But it could go the other way, right? You could see CapEx resume elsewhere because they've just been starving. These companies are not doing CapEx. Outside of AI build-out, they're not doing it. They're not doing employment. Maybe they have some pent-up demand to come back in.
No, there isn't any pent-up demand. And what's happened with the AI CapEx boom is that it's created a condition of crowding out from other sectors. I don't really like, you talk about 2.5, Atlanta Fed's at 3.9. Don't forget that the biggest contribution to second quarter GDP was the fact that imports fell through the floor because of the tariff distortions.
Yeah.
The beauty of the arithmetic of GDP, imports going down actually gives a boost to the headline. I'm not fooled by the, I'm not 2.5% real GDP. That's not happening. That is not happening in real time. And I'll tell you why it is that the NBER waits so bloody long to tell us that the recession started. The NBER had the temerity to tell us that we're in a recession in December 2008. And they told us in December 2008, months after Lehman, AIG, Mother Mary.
Just as the dust was settling from the collapse.
They told us the recession started in December of 2007, when everybody and their mother was still talking about the visions of a soft landing economy. Okay, it started December of 2007 because they wait for all the revisions to come in.
Yeah.
And so I am not being lulled into this false sense of, as you said in your title, complacency. I'm not saying, look, the earnings numbers are doing fine. But what's not doing fine is personal income. You talked about the K-shaped economy. 100%. I read somewhere that the top 10% of the affluent scale in the United States, 10%, well, they own 90% of the stock market, but they now represent 50% of the spending. And so, as McDonald's told us recently, everybody else not in that upper echelon group is skipping breakfast. But even with that, what's happening, and this is the unstable equilibrium, is trying to explain to people how is it that in totality, real incomes are running negative, 1.2 since the spring, but spending, you see, because GDP is not income. GDP is spending. Sure. And the spending is, because people are look at my 401k, look at my monthly return. And so I am going to just continue to spend more and more of my after-tax income until the savings rate gets to basically infinitesimal. We see that happen back in the late 1990s with the internet boom. Mm-hmm. People were comfortable spending almost all of their income. We're seeing that play out this time around as well. But there's a big gap right now. An epic gap between personal income and consumer spending. If you just look, by the way, because nobody looks at income, they just look at spending because we're all narcissists. If I told you that consumer spending was negative 1.2 since April, you'd be saying, oh my God, we're in a recession. But you see, because you're talking about GDP, which is about spending. But I'll tell you something. There's a problem. I call this a low multiple, low quality economy when the spending is not backed up by income, but actually backed up by financial asset inflation. Because at some point, as Herbstein famously said, anything that can't last forever by definition won't.
I love Stein's law. I've always loved Stein's law.
So then what happens then is just pure arithmetic. Once the equity wealth effect, and it will end, and I'm not going to try and time it, but then what happens is that spending will be forced to converge on incomes. And incomes are running negative. It's just that nobody looks at that data. But I look at that data. So people look at GDP because it's all about spending, and we want to measure the economy by spending. That's how you measure success, is by spending. But the income in the 70% of the economy called the household sector is actually contracting. Now, I'll say this, I'm not going to tie this into a bearish view on equities, because there's another form of income called corporate income.
Mm-hmm.
And corporate income relative to national income continues to go up. Of course, we're seeing a lot of these imbalances. Corporate income, and a different way of saying that corporate margins continue to make new highs. But at some point, these ratios all mean revert. But that's just another extreme that we're seeing right now. Look, we've tallied up through all the corporate announcements from their earnings results from, say, July to October, and there's been more than 200,000 layoff announcements. These are announcements. They haven't happened yet. They haven't hit the data yet. The ADP is already contracting. These numbers haven't even shown up yet. Jay Powell is focused on initial jobless claims. Is he focused on what companies? And a lot of these companies, they see their stock prices surge when they announce these job cuts. But don't forget that when you lay somebody off, there's somebody else's consumer. Okay, so I'm looking at these layoff announcements. We do a running tally on it. I think that people will be surprised, even with the constraint of immigration restrictions on labor supply, that the demand for labor is declining so rapidly that the unemployment rate is going to go up more than people think. I think in the next year it's going to grip a 5 handle. And that's going to cause a lot of eyebrows to be raised. I think we will go through a sequence of negative prints on non-farm payrolls once the data start to get released again. So I think that the surprises will be to the downside. And I think that Powell is quite right to focus on the labor market. I will tell you, though, I don't think he's focused on the labor market enough. I don't think this is a gradual cooling. On the surface, it might look like that. Beneath the surface, not so much.
Yeah, there might be a failure of imagination here, but what do you expect a central bank to do? Look, if I had to argue with you, I'd make 2 contrapoints. And one would be it's hard for rates to price in more rate cuts, because they were before this meeting pricing 120 basis points of rate cuts. Now they're pricing a little less because it was another one of those really annoying hawkish cuts, which to my mind is just a form of mealy-mouthed wanting to have it both ways. All cuts the Fed does these days are either hawkish cuts, all hikes are dovish hikes. Pick one is my attitude. If you're hawkish, be hawkish. If you're dovish, be dovish. But we sold off a bit in rates because he sounded a little hawkish, and December isn't a done deal. My guess is they'll cut again in December because of the political pressure.
I agree
but that just makes it a little bit harder, And then the other factor that you might not have internalized your argument is the costs of losing elections now have increased in the American political system. So you really, in the past, if you lost an election, you retired, and maybe you built a library and you played a lot of golf and sold a book for $30 million because they're that entertaining. Now, you suddenly find yourself enmeshed in a whole bunch of court cases, which may end up stripping you of your wealth and possibly your freedom. So it wouldn't shock me if this administration chose to try and pull a rabbit out of the hat. And there are rabbits they can look to pull. I'm hearing stories, rumors and talk. In fact, in the presser with Jay Powell, he mentioned this about the possibility of banking supervision relief, where they relax some of the constraints on the banks, making it possible for them to absorb more of the bond issuance. I can imagine how that might happen. It's just another form of monetary policy easing. What do you think? Am I being nuts?
No. There obviously there's a pro deregulation thrust at the Fed. At the same time, keep in mind that they're ending QT. You would have thought maybe that would be a benefit to the Treasury market. Of course, they focused more on the forward guidance. But yeah, I would tend to agree with everything that you just said. No issue whatsoever.
How about, let's talk about the next chair of the FOMC. Any thoughts on who you think the most likely candidate is?
It's really hard to handicap. I mean, we're down to 5, right? Well, I think that the real outlier is probably Hassett, insofar as he's obviously very close to Trump and would be the FOMC meetings would be him on the phone with Trump at the mahogany table. So I think that that's I don't know what you call that, like a huge steepening of the curve and a weaker dollar. He'd be a different version of Stephen Myron. He'd just be a different version, but not a governor, but as a chairman. He's definitely the most dovish, and he would be pushing for aggressive rate cuts because he's a yes man. I think that my
yes
hope
man is equivalent to ambitious.
My hope is that it would be somebody like Waller or Warsh. Both have central banking experience. I think that I think that they would probably be good representatives of the Fed that would at least showcase some degree of independence. I think that there'd be this perception of a loss of independence if the de facto chief economic spokesman for the White House, jumps into the job. I mean, we've never seen that before. People were very surprised about Alan Greenspan getting the job in 1987.
Mm-hmm.
But he was running his own private consulting firm. The most politics he did was, writing speeches for Gerald Ford. But this would be something totally different. So I think you get 2 totally different results, by the way, with Waller or Warsh versus Hassett. But if you're going to ask me my quotes, my bet, you pin me against the wall. I think the fact that Waller is there right now, that Waller actually is sensitive to cutting rates further, but without being at an extreme. And I'll tell you that when I read his speeches, yeah, he is very thoughtful and I think very well informed and very well educated. I'm very impressed with Waller. My hope is that he's the one that gets the job.
So this is a time of miracles and wonders. You can all figure out who I'm quoting there. The issue with Waller is he is a conventional central banker, and he thinks of these issues in the way a conventional central banker would think of them. He also, I'm sure, is the best at deadlift. So if you want the strongest, I've seen the video. You can find them on YouTube. Chris Waller shifts a lot of weight when he does deadlifts. So, and the problem I think with Waller is what you're getting is a central banker who might be 25 basis points more dovish than anyone on the FMC here, but not really more than that. You'll just stretch the boundary, stretch policy rates down by 25 beeps or so, nothing else. I think Walsh is quite accommodating, from what I hear, to Trump, and has been keen to emphasize how much he wants a job. Same with Myron. I like Stephen Myron. I've met him on Zoom calls before. He's a smart guy, but I have a feeling he wants a job very badly, for good reason. I suspect Trump wants someone who will do exactly, who give him the policy mix he wants. And there's a good reason for that. The policy mix he'll want will involve much lower rates, which probably be quite good for stocks and probably quite good for his re-election, but for the congressional majorities he needs. So that's why I'm suspicious that we may get a different candidate than Waller. But time's flying. Let me ask you about something that I've been looking at in some detail recently. So Jamie Dimon in the JP Morgan earnings call gave us it's true, the wisdom that there's never just one cockroach. And he was talking about US credit markets, not pest control. What are your thoughts on US credit markets right now?
Well, I think that firstly, the market for spread product, corporate spreads, high yield and IG, I would argue, or it might be even more crazily priced than the stock market is. If you're buying spread product today, if you think the spreads make any sense, then you have to believe that the corporate default rate is going from 6% to 3% in the next year. And I wouldn't say that's a 0% probability, but maybe it's a 1% probability. So I think that the market for corporate credit is insanely priced. And I am getting more concerned about rising default rates. And, it wasn't just in subprime autos, but we were seeing it previously in credit cards. And now you're seeing some segments of the mortgage market, delinquency rates, late payment rates are starting to rise there as well. So it's becoming a little more broadly based. And I actually found interesting in the presser from Powell, he was very careful not to use the word contained. But he said, I see no evidence of any broadening out from the problems we've been seeing in the subprime market for auto loans, which has been the poster child. And I was there saying, is he going to say contained? Is he going to pull a Bernanke in 2007? But
it's embarrassing. You don't want to say that.
Of course, Jamie Dimon is right. I think he's 100% right. When you start to see these cracks emerge in one part of the credit market, it starts to spread because they're all correlated. And it wasn't just one specific part of the loan market that had these incredibly easy financing standards. And now employment is cracking. Incomes are going down. The unemployment rate is edging up. What do you think? The default rate's not going to go up, generally speaking, and it's starting in really the most vulnerable part of the market where the credit bubble formed the most. So, back in 2006, it was starting in subprime mortgages. Nobody thought that was a big problem. Believe me, nobody thought that was a big problem, even in 2007.
No, I remember it very well. I thought there was a big problem.
We all remember it now in hindsight, but you see, and now people are saying, now look, subprime mortgages, you don't live in your car. At least I hope you don't live in your car. You live in your home. But the thing is that
at the moment,
you get the same thing happened in commercial real estate. The cracks emerging with the LBOs back in 1988, 89. Okay. It always starts in one corner of the market, but all these markets in corporate credit, they're correlated with each other, and the reckless financing and the easy lending terms, they're not just confined to one market, but that's where most of the leverage was. But there will be spin-off effects. But of course, at the start, it's always a case of putting a brave face on it. I really respect Jamie Dimon. I mean, when you think about it, it's very important what he said, because he's got a smile on his face 95% of the time. 95% of the time, Jamie Dimon is Mr. Happy-Go-Lucky.
If I was
So
Jamie Dimon, I would have a smile on my face too.
It's not like well, look, I'll say it's not like Dave Rosenberg saying, "Oh, the sky is falling." Well, there's Rosenberg. The sky's always falling. This is Jamie Dimon, who's usually very optimistic. So I think we have to take what he's saying very seriously, and especially now when credit spreads are nothing more than stupid tight.
They're pretty tight. I agree.
Stupid.
So look, I want to quibble with you a bit about a couple of things. Number one, Jamie Dimon, it's not exactly a statement against interest, because he's probably shopping for the kind of businesses that will fail if there's a contagion event in private credit. So it wouldn't. You got to be kind of careful, especially when somebody says Jacques and points over there. You have to ask. Of course he's going to say that. His business is fine. Other people's businesses have problems. I'm with you about when you start seeing failures. There are two reasons you start seeing failures. One is because they're credit excesses, but the other is because you can't roll over debt anymore. And there must have been a slight tightening in credit conditions so that people couldn't hide it anymore. So the kind of classic J.K. Galbraith Bezel idea that comes to mind.
It's part of the K-shaped economy.
Yes, it really is.
Subprime auto loans. When you're taking a look at who are these subprime mortgages? Who are moving into those homes? Okay, who are the easy access to credit being provided for? So this is part of the K-shaped economy. K-shaped economy. These people that are living paycheck to paycheck, and it's a vastly expanding number.
I think
so. They're living on. Harry, they're living on credit. Look at this whole.
Sure.
You don't think the BNPL, the buy now pay later? Do you notice that as we're talking more and more and more about K-shaped economy, the buy now pay later, people. I just said before, and the reality is that the people like the top 10% that are all in on the stock market, that is not the broad society. The broad society have been living on credit, and now they're losing their jobs. Right. So I don't know so much about credit financing activities tightening up. In response to the fact that the late payment rate is going up because people are losing their jobs, they're losing their incomes, their debt servicing capacity has been impaired.
So and that's definitely one hypothesis.
You don't believe, people who are watching this don't believe that there's a recession in the economy. I got to tell you something. There's a recession in wide swaths of the economy,
right?
Especially in the years. But the thing is that it's once, especially when it's employment and income, these things move in a trend, right? He's talking about Powell. It's gradual cooling. It's not gradual cooling. By the way, the Schiller Home Price Index is down like in 5 of the past 6 months. Like do you see what D.R. Horton said? D.R. Horton, and their margins are getting crushed. Their prices are deflating, and that doesn't even. And that's when you tack on the discounts and the home build. We're talking about a booming stock market because of AI. Meanwhile, the home building stocks are down 13% from the recent highs, and the residential REITs are down 22%. And we're talking about a real bedrock here.
Yeah,
called housing.
Yeah, I struggle a little with that simply because they are down, but they're down from really high levels. So we don't. It's not.
That's the argument of the Nasdaq collapsing in March of 2000. That's coming. You're always coming off a high level. The peak in the S&P on October 9th of 07. Don't worry so much. We're coming off a high level. You know the old adage: the higher they are, the harder they fall. Okay. So, yes, we're coming off a high level. Yeah, I get it. Especially when you're talking about a 40 multiple, a Cape multiple, a Schiller multiple in the S&P 500 is 40. It's only been this high one other time in the past 100 years, and that was back in the late 1990s. The late 1990s, the mildest GDP recession in recorded history, precipitated like an 80% collapse in technology stocks. And I remember what they were saying back in 1999. That would have been viewed as being impossible. And now, of course, you have an industry of people on Wall Street, how it's different. This is not the dot-coms of the late 1990s, right? This is not that, because we have companies with real profits and real business models and real cash flows. What are you talking about?
Oh, you're quoting Jay Powell now, aren't you?
It was not a dot-com bubble in the late 1990s. That's the fallacy. It was a broad technology bubble, okay? Because Microsoft is not a dot-com company, okay? And its stock still went down 60%. Intel, Dell, Cisco, IBM, they all went down between 60 and 80%. They were not pets.com. They all got caught up in a broad technology bubble. And back then, of course, that wasn't the Nifty 50. If you remember back in the late 90s, this is not the Nifty 50. This is not the Nifty 50. So people wake up, and as Bob Farrell famously said, exponentially rising markets go further than you think, but they don't correct by going sideways. And we reached a standard deviation event on the multiples back in the summer of 2024. But you see, the thing is that you can be in a bubble between 18 and 24 months. We're basically, call it a year and a half. This could go on another 6 months. Okay. And people will say, well, I got to be in there for the next 6 months. I got to be in the bubble for the next 6 months. I sort of think, if you talk to we were talking about our great grandfathers before the show.
Mm-hmm.
So if their advisor said, get out of the market in 1928, you tell me in 1933, did you yell at your advisor? Why did you get me out so early in 1928? In 2003, were people yelling at their advisor, why did you get me out in 1998? You cost me a whole year. Really? Like in 2009, were you yelling at your advisor? You got me out in 2007? What are you, crazy? So here's the thing. People, it's the one thing that hasn't changed, right, over the millennia, is fear and greed.
Sure.
Fear and greed. You opened up your segment with the complacency. The greed level, you look at market vein sentiment, 70%. It doesn't get bigger than that. You got in the Investors Intelligence Survey, you're down to 13% bears. There's no bears. There's no bears out there. And that's an extreme. I think it's only been that low before in December 2018. In January of 2018. Well, you know what happened next in the next 10 months. In any event, what can I say? I turned 65 today. I've been doing this for 40 years. I've been through the rodeo a lot, and I know the BS when I see it. And people will say to me, well, you're some radical perma bear. No. I just basically believe in risk management and capital preservation.
Yeah, sometimes you just have to say what you think, even if you're going to be a little early.
Being early. That's the thing, is that
early might be better than being late.
The thing is that bull markets are escalators going up over time.
Yeah.
And bear markets, they're elevators. That's an elevator.
Yeah, that's right. So I just wanted to give you one anecdote, because you said that nobody was saying that there was a housing bubble in 2007, 2006. But actually, a lot of people knew. I remember this really clearly because I went in to see Ben Bernanke at the Fed, and I made the mistake of telling him, do you not think there might be a housing bubble? This was, I think, 2007, early 2007, sorry. And he gave me a look like I just said something like, why do you shine your head? It was, and I was basically showing the door. Out you go. Yes, that's right. And it was not the right thing to say. It was. I think he took it badly. Josh Rosner, a buddy of mine
mine too. I love Josh.
Right, Josh Rosner was calling a housing bubble way before, and we know that Goldman Sachs was placing Muriel Rubini.
But we were viewed in the lunatic fringe. You know, when I was at Merrill Lynch, very senior person told me in 2007 to stop using the word housing bubble. I was not permitted to use the word bubble anymore. Okay.
I happen to have a good insight into how many
and
CDO
Merrill
squares
Lynch is
Lynch is
slightly bigger
carrying.
than Josh Rosner. Okay, as much as I
Yeah.
love Josh. Okay, and so I just said, well, can I replace it with another word? I said yes. So I said, how about mania? They said that's fine. I said, okay, I'll go with that one. But you know, that's the thing. Look, I was instructed, and I've written about this, by the way, that I was not permitted to use the word bubble because it was making people upset.
Yeah, brokers.
And that's why, and that's you know what? That's when you know you're at a market peak, because right now, you know, if you tell people that we're in a price bubble, we're in a price bubble.
Wash your filthy mouth out. How could you?
Well, it's basically, well, I can understand it, because a bubble, you know, people think of 1929, they think of, you know, 1950 in the late 60s, they think of, you know, the great financial crisis. I'm not saying any of that. It's basically, as Jeremy Grantham famously said, anything that gets to a 2 standard deviation event on their valuations, that's your bubble. And then we can try and estimate how long can the bubble last. And the bubble can last 1 to 2 years. I'm not going to dispute that, but so long as people can understand that you're investing in a 2 sigma event. So I never said to anybody, you got to sell your portfolio, but maybe you want to have some hedges.
Yeah.
Maybe you want to sell call options against your equity portfolio. And if the market doesn't go down, the worst you did was you collected your premium. I'm just saying that when you get to the bubble environment and you love your portfolio, you can't part with your portfolio, build up hedges and buy some insurance, especially now when it's so dirt cheap. Because nobody believes that we're going into a recession. Now, that might be your view too. However, let's just say that people believe, after the fact that we did not go into recession when we, quote, should have in 2022, 2023, it's called hubris. People now believe the business cycle has been repealed. There will not be a recession, and nobody believes that there will ever be a bear market again.
David,
so I'm just saying that's where we are.
It's been a great pleasure. We've overrun by 15 minutes. Forgive me for pushing it too far. But what can I say? I think it's a useful message. Thank you so much. Good to see you again.
You as well.